Navigating the regulatory landscape. The impact of the Dodd-Frank Act on financial institutions and investments. In the intricate web of financial markets, regulatory changes wield profound influence, shaping the contours of how financial institutions operate and how investors strategize. One such pivotal regulatory milestone is the Dodd-Frank Wall Street Reform and Consumer Protection Act, a sweeping piece of legislation enacted in the aftermath of the 2008 financial crisis. Understanding the impact of the Dodd-Frank Act on financial institutions and investments demands a journey into its multifaceted provisions. Unraveling the complexities that reverberate through the financial sector. The genesis of Dodd-Frank. Enacted in 2010, the Dodd-Frank Act emerged as a response to the systemic failures that triggered the global financial crisis. Crafted with the intention of fostering financial stability, protecting consumers, and mitigating risks in the financial system. Dodd-Frank introduced a comprehensive set of reforms affecting banks, financial institutions, and the broader financial landscape. One of the primary objectives of Dodd-Frank was to address the perceived excesses and regulatory gaps that contributed to the crisis. The Act sought to enhance transparency, fortify regulatory oversight, and instill safeguards to prevent a recurrence of the events that led to the near collapse of major financial institutions and the subsequent economic downturn. Impact on financial institutions. Dodd-Frank ushered in a new era of scrutiny and accountability for financial institutions, redefining their operational landscape. One of the key provisions was the establishment of the Financial Stability Oversight Council, FSOC, tasked with identifying and responding to emerging risks in the financial system. Systemically important financial institutions, SIFIs, came under heightened regulatory scrutiny. Subject to more rigorous oversight and capital requirements to mitigate the potential domino effect of their failure. Additionally, Dodd-Frank mandated stress testing for large financial institutions, ensuring they could weather economic downturns without jeopardizing financial stability. These stress tests became a pivotal tool for regulators to assess a bank's resilience under adverse economic conditions. Fostering a culture of risk management and prudence within the financial sector. The Volcker Rule, another cornerstone of Dodd-Frank, aimed to curb excessive risk-taking by prohibiting banks from engaging in proprietary trading and restricting their investments in hedge funds and private equity. This provision sought to insulate commercial banking activities from the speculative behavior that contributed to the financial crisis, reshaping the risk appetite of financial institutions. Consumer protection and transparency. Dodd-Frank's impact extended beyond the boardrooms of financial institutions, reaching into the realm of consumer protection and market transparency. The Consumer Financial Protection Bureau, CFPB, was created to oversee and regulate financial products and services, safeguarding consumers from predatory practices and ensuring transparency in financial transactions. The Act also introduced reforms to the mortgage market, imposing stringent underwriting standards to prevent the proliferation of risky mortgage products that played a pivotal role in the housing market collapse. Lenders faced increased scrutiny, and consumers were afforded greater protection against deceptive lending practices, contributing to a more stable and sustainable housing market. Impact on investments. For investors, the repercussions of Dodd-Frank were far-reaching, influencing the risk-return dynamics of various asset classes. The regulatory changes prompted financial institutions to reassess their investment strategies, with a renewed emphasis on risk management and compliance. As banks adjusted their business models to conform to the new regulatory landscape, investors witnessed shifts in the risk profiles of financial products and services. The Volcker Rule, in particular, had a palpable impact on the investment landscape. Hedge funds and private equity funds faced restrictions on their interactions with banking entities, altering the dynamics of alternative investments. Investors navigating these changes had to recalibrate their portfolios, considering the implications of reduced liquidity and altered risk exposures in certain asset classes. Furthermore, increased regulatory oversight and compliance requirements introduced additional costs for financial institutions, potentially affecting their profitability. Investors keen on financial stocks had to factor in the evolving cost structures and regulatory burdens borne by these institutions when assessing their investment potential. Global ramifications and adaptations. The Dodd-Frank Act, though originating in the United States, reverberated across global financial markets. International financial institutions with a significant presence in the U.S. had to align their operations with the new regulatory framework, navigating the complexities of compliance on a global scale. The extraterritorial reach of Dodd-Frank impacted foreign banks conducting business in the U.S., subjecting them to similar regulatory scrutiny as their domestic counterparts. This harmonization of regulatory standards sought to create a level playing field, minimizing regulatory arbitrage and reinforcing the interconnectedness of the global financial system. Adaptation and resilience. In response to Dodd-Frank, financial institutions embarked on a journey of adaptation and resilience. Regulatory compliance became a focal point of their operational strategies, with investments in risk management systems, compliance infrastructure, and technology to meet the evolving regulatory demands. While these adjustments incurred costs, they also aimed to fortify the stability and sustainability of the financial system. Investors, cognizant of the shifting regulatory landscape, incorporated considerations of regulatory risk into their investment analyses. Understanding how financial institutions navigated the challenges posed by Dodd-Frank became integral to evaluating the resilience and long-term viability of investments in the financial sector. Conclusion. The Dodd-Frank Act stands as a landmark piece of legislation that reshaped the financial landscape in the wake of the 2008 financial crisis. Its impact on financial institutions and investments has been transformative, ushering in an era of heightened regulatory scrutiny, risk management, and investor awareness. As financial markets continue to evolve, the legacy of Dodd-Frank serves as a testament to the dynamic interplay between regulatory changes and the resilience of financial institutions and investors navigating the ever-shifting currents of the global economy.